Welcome back to the Dividend Diplomats YouTube channel. You know you've got Bert and Lanny, the DD guys, your favorite and best dividend YouTube channel here on the market. We're talking about two dividend stocks in the health insurance industry, high dividend growth players, high revenue and earning players. Let's dive into two dividend stocks possibly to buy right now.
But before we do, Jack, you got to subscribe to this channel and give this video a thumbs up. You take those 24-inch pythons and you buy yourself a Dividend Diplomats coffee mug, Jack.
Oh man, oh boy. Well, that's the bottom line because Bert said so. Guys, we are diving into two stocks. Stock market is kind of going through a little bit of a turbulent time right now. You know, the S&P 500 over the last 5 days is down about 2.5 to 3%, back below 4,000 in the S&P 500. Still up year to date though, about 3.5 to 4%. Again, in the S&P 500. But you know, we've gone through a lot of dividend increases this year, a couple painful dividend cuts that you've seen on our last few videos or last video. So let's get back to some strong, high quality, high dividend growth, high earning dividend stocks, where I think one might be a great stock to buy right now here to finish off February and enter March of 2023.
We're very excited to talk about it. And as we do with all companies, we run them through the Dividend Diplomats dividend stock screener that has 3 simple metrics and 1 bonus metric. First metric, price earnings ratio less than the S&P 500. 2, payout ratio less than 60%. Although we do think that perfect payout ratio is between 40% to 60%. 3, history of increasing dividends, where we look at the 5-year average dividend growth rate and how many years in a row a company has increased its dividend. And last, but definitely not least, that bonus metric, the dividend yield.
Exactly, guys. So we're going to get down to the brass tacks. We're in the health insurance industry, brother. And guys, this is really, between year ends and during the quarter ends, a lot of health insurance renewals are occurring. And it's pretty amazing to see what these industries are going through right now. Obviously, they're also fighting inflation and passing inflation on to companies, and the companies are passing on that as well to the employees. So health insurance and costs are rising right now, along with everything else. And what that means for insurance companies, more money in their pocket, truthfully. So we're going to be looking at Elevance Health, which is formerly Anthem, ticker symbol ELV. We're going to look at United Health, ticker symbol UNH. It's pretty interesting that ELV or Elevance is actually 115 billion in market cap, huge, but that's still is only about 1/3 the size from a market cap standpoint versus UNH, which is around 452 billion by market cap. So it's pretty amazing how large these companies actually are.
I know, I was going to say, it's insane when you put the market cap side by side. ELV is big enough on its own, but UNH is just like, get over here, little brother. I'm just going to flick you off for market cap here. But that's probably needed for the health insurance sector. If you really think about it, they go through a lot. A lot of claims, a lot of processing, a lot of revenue. There's a lot going on. So size matter, you got to get some of these large corporations, all these different ways. There are some big economies of scale to be had and benefit from in the health insurance sector.
Yeah, no, there's no doubt about it. A lot of economies to scale. You obviously hope that claims are less than projected. I think that's every insurance company's goal there. Big investment portfolios as well.
Yeah.
So a lot of their earnings can swing with the value of those equity investments as well. So always keep that in mind when you're looking at the insurance industry in general.
That's how I think that's why I think the fascinating thing about insurance companies, and that's where a lot of their money is made. It's on the investment portfolios. It's how strong are they from the investment side that helps cover all of those losses. That's the interesting little secret in the insurance sector.
Yeah, we're using stock prices close as of February 24th, so Friday. So that's what we'll be using. We'll dive into each company and we'll talk a little bit about the details. I actually do own ELV, so a little disclaimer there, and we'll see if I'm looking to add to one or both positions, and same with Bert. So again, Elevance, Bert, ticker symbol is ELV. They're trading at $478 right now. So this stock price seems outrageously high, but it's all relative, right, Bert?
It is, and that's what makes me laugh when we see the EPS, because that seems high too, but it's just part of the share count. That's all it really is. Their EPS is $32.76. That gives you a PE ratio of 14.59, trading below the market. That's what you want to see right now.
Yeah, the market right now from a PE ratio standpoint is about 21 times earnings. So yeah, definitely trading lower than that. Then, once we dive into UNH, which we'll cover after ELV, we'll see if ELV is trading at a lower valuation than UNH. Currently, ELV right now pays a nice, when we dive into the payout ratio, they pay $1.48 per quarter per share. I mean, ELV is definitely, it's interesting because they just also increased that dividend from $1.28 to $1.48. So a pretty sizable increase nonetheless. That equates to a small payout ratio, again, $5.92 annually. Taking that over the $32.76, payout ratio is only 18% right now.
Beautiful. Let's talk about the dividend growth. 5-year dividend growth rate, 12.42%. They've increased that dividend for 11 plus years now after that last dividend increase that you talked about, Laney. They're very close to being halfway towards becoming a dividend aristocrat, which is a company that's increased its dividend for 25 plus consecutive years.
Again, we're kind of piggybacking on previous increases from, when they were ANTM, Anthem. They've just increased their dividend, call it 20 cents. What is 20 over 128? 15.625%. So their last increase was better than what they traditionally do.
Beautiful.
And how do they do that? I mean, we'll get into it really quick, actually. Anthem, they've had revenue growth consecutively the last few years. They've had net income growth consecutively the last few years. So if you have a high revenue and high income and high cash flow generating business, that allows you to grow the dividend faster, unlike some companies that may have just recently cut their dividend.
Yeah, it sounds like they like to make money and have fun, is what I'm hearing.
Spot on. Love the quote.
Yeah. So yield, let's talk about their yield. If they're growing their earnings, they're growing their revenue, and they've been able to grow that dividend. Where's their yield? We know they have a low payout ratio at 18%. So we're not expecting a yield to jump out of the roof. Their current dividend yield is 1.24%.
Low yield, but high dividend growth, guys. The combination there is closing in on 17%. Yield plus growth. So that yield will, that yield on cost will grow at a pretty fast clip. And I don't see any reasons with the earnings growth, the payout ratio, why that would stop. Again, down about 5% this year, up in the last 52 weeks, though, about 5.5%. So, they're down, the market's up. So again, you kind of got to look at that as another little opportunity for buying individual stocks.
Yeah, so let's summarize before we move into UNH. PE ratio 14.5, payout ratio 18%, 5-year growth rate at 12.42%. They've increased that dividend for 11 years, and that yield is 1.24%. Lanny, take away the PE ratio for UNH here.
So guys, UNH, so they're trading at $484, so very close in price to ELV. It's like, maybe this is like the trend in the industry, right? Now their forward earnings are $24.94. So that price to earnings ratio is actually 19.4, so about 5 higher than ELV and trading just below the S&P 500 right now.
All right, their annual dividend is $6.60. Gives you a payout ratio of 26.46%. So,
oh wow,
yeah, it's very low as well, like ELV, but still way below the low end of our perfect payout ratio range.
I mean, very safe dividend payout ratio. They must have a high dividend growth rate. Let's dive into that right now. They've actually increased their dividend for 13 plus years. The 5-year average is 17.38%. So definitely high. Definitely has still room to run too.
Perfect. So let's talk about that yield. Higher payout ratio should trend to a higher yield for UNH compared to ELV. Remember, ELV's yield was 1.24%. UNH's yield is 1.36%. So you're picking up 12 basis points here.
Picking up 12 basis points, obviously with the high dividend growth rate. That combination factor right there is almost 19%, and compared to around the 15 to 17% from ELV.
Yeah.
They're down about 6.6% this year, but up about 2% in the last 52 weeks.
Yeah, so they performed a little worse than ELV. ELV, remember, is only down 4.81% and up 5.36 over the last 52 weeks. So keep that in mind. Let's summarize UNH. PE ratio 19.42, payout ratio 26%, 5-year growth rate 17.38. They've increased for 13 years with a yield of 1.36%. Lanny, do we want to quickly run through some of the metrics from their last earnings release? Just quick financial hits for each company.
Yeah, I mean, at least for on UNH assets, we just covered them. You know, they have over 23 billion in cash equivalents on their balance sheet. Pretty nice to have. But the interesting part is that current assets over current liabilities is actually below 1 right now at 0.77, which I found pretty interesting as of the year end of 2022. But revenue growth from 2020 through 2022 is pretty staggering, from 257 billion all the way up to 324 billion. So the growth rate on revenue is pretty amazing, and net income has risen every year as well from that time period.
Beautiful. Let's see how that compares to Anthem. 7.4 billion cash on hand, so less cash on hand, but they have they doubled up the payout, the current ratio. I mean, their current ratio is 1.4x. So obviously that's the trend you want to see. That's kind of what we were expecting for both companies in this sector. And much like UNH, you're seeing high revenue and high earnings growth, all positive in the direction. So pretty similar. Big difference, less cash on hand for Anthem, higher current ratio. That's really kind of the only thing that jumps out.
Yeah, so we're going to show the stock charts here on the screen. So the big question is, are you guys interested in buying lower yield but much higher dividend growth stocks right now here and entering March of 2023? Again, I own ELV. My take is, if ELV, I like ELV more than UNH just based on metrics, lower PE ratio, lower payout ratio. Even if it has a slightly lower yield, again,
I was going to make fun of you for being biased because you own them, but you're not wrong. ELV is just trading at a lower valuation right now. And the drop off in yield of only 12 basis points going from 1.36 to 1.24, in my mind makes this a no brainer with everything else considered, that ELV is the better value today.
Yeah. But what do you guys think? I mean, Bert, what's your take on both companies? Will you be buying? Are you going to watch any of them, or?
I mean, I'm going to watch. I think ELV is the one. If I'm going to pick one to put on my watch list, it's going to be ELV today. That simple. I mean, both are great. If you're looking for one in the sector and you tell us you wanted to go with UNH over ELV, perfect. We get it. It's a great company too, but both diplomats are swinging more towards ELV today. That's all.
Guys, you heard it there. Both stocks really solid, really sound, lower yielding, but in the future, your yield on cost should be very high after a few short years of owning these stocks, given their track record of previous net income and revenue growth. So do you guys own these companies? Let us know in the comments below if you own ELV and or UNH. I'm sure there's going to be a lot of UNH shareholders possibly, is my inkling inside, but let us know your feedback in the comments below.
If you haven't already, subscribe to this channel. Give us a thumbs up. And remember, everybody, if you're not with us, you're against us.
That was Bert, the Hurt, and Lanny from the Dividend Diplomats. Over and out.